Hello ladies and gentlemen, welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's topic, ladies and gentlemen, we will take a look at an advanced news trading system which is based on a technical perspective with market pricing. What I'm trying to focus on today's system is more of a technical approach when we're trading major fundamental announcements. First of all, I will start with comparing what a major fundamental announcement is. Some of you might already know that, but for those that are wondering, we are only focusing on high volatile news. So if you are looking at the economic calendar and for large volatile news you have, let's say, 3 A's or 3 attention marks as we have it in our economic calendar. For mid volatility we have 2, and for small volatility or low volatility we have only 1. So we're focusing on 3 A's or 3 attention marks volatility, high volatility expectations. Such news are, for example, the non-farm payrolls, let's say, interest rate decisions, central bank announcements, so on and so forth. To compare this with something that we recently saw is our focus today, and mostly we will be looking right now on the cable, or the so-called cable, for our GDP USD, Great British Pound versus the US dollar. Particularly, this currency pair has high volatility on a daily range between 100 to 150, 170 pips. Focusing on high volatile pairs is also extremely important for this system to work. Basically, what we're looking after is high volatility and large volume cash on the market. What you're looking in front of you is the GBP after the last non-farm payroll announcement. When I'm speaking of last, I'm not speaking of the one that happened in April. That was for March, basically the one which was last week. I'm speaking of the one we saw in February. The one we saw in February was announced March 6th. As you can see in front of you, the large candles forming on the cable are exactly at that time. This simple or should I say, for some not so simple, trading strategy focuses and also allows you to capitalize on most volatile movements on the Forex market. So for example, as we saw, every first Friday of the month, sometimes it's the second one, we have an announcement for the non-farm payrolls. All right. Every month we have a Federal Open Market Committee minutes, announcements, such as today at 6 p.m. GMT time. We have FOMC minutes. Extremely important, and based on the expectations and mostly investor sentiment, we can see that the market is already pricing in for what's expected to come later. And without giving you just hints, I will just let you know, as we are looking at GDP numbers, also one very large fundamental that plays extremely huge role to assess the timing of interest rate increase, for example, something that markets are focusing at this point of time. Also, we need to remember that when we're looking at such announcements, the market is expecting, and it already knows what is going to happen. More dovish announcements from the Fed today will bring the dollar lower. One thing, of course, is extremely important to remember, ladies and gentlemen, when we're talking about expectations, that means something is going to happen shortly in time, sooner rather than later. So what can only happen is that the time can be delayed as far as the beginning of next year or the end of next year. That's as far as the Fed can go. However, the unexpected might happen for them to raise interest rates later this year. That's September, October, or November in their meetings. Now, this is what the market is pricing for. So when we're looking at prices of currencies and commodities compared to the US dollar, they're all rising. Slightly before the announcement, they're pricing in down. Everyone is taking the profit that recently they made. Of course, when we have a lot of something on the market, it gets a little bit cheaper. But when it's cheaper, people start buying it because it's cheap. And eventually, controversially, of course, price is starting to climb at some point of market exhaustion. Now, this is what we saw today, for example, on gold price. Let me mention that. Briefly before the European market opened, we saw $5 gain in gold after it dropped yesterday to 1207. Then it went back up to 12, 1250, 1213. That's roughly $45 gain, and this is an early indication what market is up to. People are buying it because they're not expecting any change from the Fed, not on today's meeting. That will give a little bit more room for those different currencies compared to the US dollar to climb. Some of you already have figured that out, of course. Prior to US market open, which we'll see in about an hour and 20 minutes from now, everyone is taking their profit at the end of the US session, European session. When the US session starts, the market will start pricing in for the action tonight prior to the news. And when we are expecting no change, there is only one way for the price to go. This is an explanation from a fundamental point of view. And when we're speaking about technical point of view, there is a little bit of difference over there, because we don't really try to catch the bottom or the top of the price to catch the whole movement. We are much more conservative to our trading, and we rely more of a more on technical perspective to make our profits. So we're not aiming for a, let's say, for example, for a full 100 pips of profit. We're aiming something between 60 to 70, maybe 80 pips of profit in between that move. Now, on a typical announcement day, large volatile pairs will move with approximately 100 pips in range at the direction of the expectation. What you need to be informed of is that daily upcoming news releases, as well as getting comprehensive analysis on multiple markets before you start your trading day, you need to set up for what's coming on the market. So you need to get your mood straight. You have to be prepared by, mentally prepared for what's going to happen, because the usual mistakes people make are to rush into the market with the flock, for example, way before the news. And let's say you have no idea what the announcement would be. let's say there is no market sentiment, no investor sentiment, no indications that would point something in a direction that you will have more than 80% certainty that the market will go that way. Let's say you're only taking a technical stance. So you're observing your calendar. You know at what time the market will have an announcement, and you're patiently waiting for those news releases. What happens is this particular system uses 15-minute chart, as you can see in front of you. Clean chart, only candlesticks and 1/200 exponential moving average, which every chart should have. Every trader is looking at the support resistance levels of this 200 exponential. A 15-minute chart, ladies and gentlemen, allows the initial volatility to subside, but still allows us to capture a large potential move once the market participants make a more rational decision about whether they want to buy or whether they want to sell based on the news release. This is the trend which the market will move, and the strategy that attempts to capture is the rational trend which follows the initial surge. For example, if the price is going higher. Also, other currency pairs volatile like Euro USD could be used, USD JPY, should we say some exotics, GBP JPY, New Zealand JPY, New Zealand USD, Aussie USD, so on and so forth. If you are looking at the particular economy. If, of course, you're looking at announcements during the Asian session, like what we saw recently on the Bank of Australia, no change in the interest rate, the Aussie surged 150 pips, maybe 200 pips up. The system has rules. We do nothing at the first 15 minutes after the announcement, after the large announcement. What I mean is this particular huge candlestick here. I'm going to go around it very slowly so I don't touch anything else. It might seem a little crooked, but this huge candlestick here is formed at the announcement, at the moment of the announcement, when the news are coming out. Bam, there you go, huge candlestick, 100 pips in range. That's great, we like it. We see that the market is going to point down. We need to wait for the inside candle, the most important candle of the whole structure of this chart here. This one comes right after the market has cooled. This is the one that we need. The small, ugly candlestick inside it, inside the two big, large candles. Now, the wide-ranging candle, the first one as I pointed, and the inside bar or the inside candle are observed on 15-minute chart. It shows a wide-ranging candle followed by an inside candle. The inside candle doesn't always immediately follow a wide-ranging candle. Depending on the volatility of the pair, the usual daily volatility on the pair that you're looking at, we may need to wait a couple of candlesticks more in order for the inside candle to occur. The inside candle also doesn't need to be inside the wide-ranging candle. So you see, we just need a candle that it's inside another one. And you have it over here. You can see how this one, it opens and closes inside the other one. So this candle, we do not trade it. This is the one we need. After this 15-minute closes, this is our entry. Where is our exit? I will tell you later. Our exit is time-bound. Why? because of the trend and its current money flow. Let's first focus on the high and low of this particular inside candle. That becomes actually your trading trigger. If the price rises above the high of the inside candle, in some cases we go long from a technical perspective. If the price drops below the low, the inside, we short or we sell. As we can see over here, let me erase that. The closing is well below the closing of the other one. So this is our short signal. When this one closes, on the following one, we automatically sell this instrument. Now, the next thing we have to talk about here is the exit. Now, why we're choosing such an entry, I will come back to that. But first, I don't want you to wait and wonder where you should exit. Our exit is 4 hours after our entry. As I mentioned, this is a time-bound or a timed exit. Once the trend begins, ladies and gentlemen, it will often last about 4 hours. Okay? If we enter at a certain point of time, we have to exit the trade at a certain point of time. Even if it has not been 4 hours since your entry, for example, we also have to exit at a certain point of time when we see that the market is retracing back up. However, 90% of the cases is that this trend will be valid for as long as 4 upcoming hours as you enter. Now let's take a closer look at this exit that we were talking about. I want to focus on our entry and our exit. First of all, we have to calculate, as we're looking at the 15-minute chart, we have to see how many candles we have to wait, what would be the time that we have to exit. The very simple way to calculate this is, as we already know, that we have to wait for about 4 hours time. And as we already know that we have to find out how many candles we have to wait. In this particular case, on a 15 minutes, that means we have 4 hours, 60 minutes to in an hour. So that's 4 multiplied by 60. We have 240 minutes for the 4-hour time frame. And when we're looking at a 15-minute chart, we divide it on 15 and we will get the number of candlesticks that we need to wait. So we're getting 16. 16 candlesticks after our entry, we have to place our exit. So from here, we measure 16 candles. 16 candles are exactly here. As you can see, the first number is 16. Exactly on the 16th candle, we have 73 pips of profit. It's over here. This is our exit. Even if the market continues to the downside for the next hour, an hour and a half, maybe a little bit more, we don't really care. We already made our profit. In 4-hour trading with one lot, we made $730. So when we know that this doji here is our exit, we should measure to see in pip size the far bottom is 28 pips. So does it really worth 28 pips against 73, 74 pips here? Because I don't think so. Because as you can see that if you wait too long, you will have more than 60% retracement, which brings it by far extremely close to your entry. And you're left with about 5 to 10 pips profit, and you will very much regret it. So this timing, this time-bound exit is extremely important to our system. That is why this is our major rule. Here is the moment where I would make a few deviations from today's topic. Some of you that are new to our establishment, to the webinars, that you're here for the first time, any questions that you might have, whether or not you are a trader of the company, there is always a chance that you can get in touch with us back. Whether type your your message down here in the chat, leave us contact details if you have some questions about the market, or you want to fire away with a question. I will be always able to do so. React on time. Usually I'm doing it after the webinar, as I don't really want to to take up much of your valuable time, so you can focus on any kind of strategy that you like. Or if you would like to have a personal session with us, me or one of my colleagues, depending of course on your needs about the market. For more complex trading techniques or deep depth market analysis, I would be able to help you on a one-on-one session, as we usually do it. We can sit along for hours and hours and analyze the market if necessary. Or if you have any general question about the market or the company, something that you can always get as an information from our support department, or directly to webinar@gdm.com. You can forward your questions. We're always answering as soon as possible, as soon as we receive all of your questions. So now, extremely important rule number 2. Okay, in rule number 1, as we mentioned, we should always exit at the 4th hour of our trading. So as we're looking at a 15-minute chart, these are 16 candles counted from your entry. Okay, this is your 4th hour. Whether or not the market will continue to the same direction, we don't really care. This is on what we're focusing as a particular strategy that it works. Market usually exhausts its power on the 4th trading hour after the surge of the market. Also, something that I need to mention here is for a smaller time frame. Okay, I remembered that a 5-minute chart can also be used in this particular strategy, but is, should I say, it's bound to more false signals, as the inside candle, when it forms, it's much more accurate on the 15-minute chart. As well as some of you guys that has been very, very long with us, you already know the previous news trading strategies that we've discussed that are strictly 30-minute chart bound, which means we're actually trading on a break-off and a type of support and resistance break-off system, as we mentioned. Though this one is focused mostly on a pending order type system. This one you can always use, of course. This is by far the most simplest way to trade news, as well as technically traded. Among you, probably there are a lot of riskier type of traders that might want to catch this particular move here, especially from the opening. But let's see here, we have about nearly 50 pips upside. You see, this is a lot of risk, and about the same size candlestick to the downside. So we have long shadow, pretty much the same size as the real body of the candlestick. This is the market noise before and at the announcement. This is something that it's by far considered the most risky type of market trading, trying to guess the news. Don't do that. From experience, I can tell you this is possible to wipe your account in one single move, if of course you don't guess it right, and the market pretty much is not a casino, should I just put it this way. Okay, now third most important rule don't take more than 2 trades. Now, if you get stopped out on 2 trades, that means the movement is too choppy. That means there will be no development on a direction. That means we will see only sideways movement, choppy trading up and down, nothing that will bring you profit. That means you don't use that particular strategy. You have to use another one that is mostly side range bound. That's the way I like to put it. This particular rule is optional, of course, but you can implement some sort of trailing stop, for example, to avoid giving up your profits if the trend reverses while holding the position. So let's say you're in the right rate market. You have set some kind of price trailing that in case of a reversal you will book your profits when the trend reverses, something that more of a risky type of traders are doing based on the fact that they're actually trying to catch the full move down in this case. All right. Even if I show you different currency pairs, commodities, or anything else, still the same thing. What I'm actually interested more is to see your reviews of this particular strategy. So I would even so urge you to search back in history. Major announcements, even the recent ones that we are expecting or that we had, or those that we are expecting today. Have a look and see at the 15-minute chart how this inside candle figures, and after it actually is established, then you will see how the market continues in the right way. So why are we looking for this inside candle? We're looking for it because this is the candlestick where the market calms down, where all the news are out, everything is now known, and the market takes its way at the right direction. Everyone is starting to sell the instrument, in this case here. Before that, there are so many buyers and sellers on the market that you will get so confused. Now, the way you see it here, this is already happening. This one is already done, and you can see how it looks as a established chart. But once you're in this candle here, and in these 15 minutes, the price hikes from bottom to the top, and this whole shadow to shadow is 107 pips in range. So you see these 100 pips on one lot, this is 1,000 US dollars. So you will be gaining 1,000, then losing 1,000, then gaining 1,000, losing 1,000. This is not what we're looking after. It's too big frustration for any trader to bear. It's going to shake your psyche, your brain so much that the right decision will be very difficult to make after the movement is over. Because once you make a profit, you will book it because you're already tired from this move. Your brain is flooded with whatever thoughts you were already having, whether it's going to reverse right away. So I have $100 or $200 profit. That's great. I just took it. But if you only use it, this particular strategy, the right way, you will not only have a peace of mind after the announcement, but you will always be gaining more than you will eventually be losing when the strategy fails, for example. As I mentioned, if you get stopped on 2 trades, you will always be able to reevaluate this particular strategy and say to yourself that it's not exactly what I'm looking for. There is no inside bar, so I have to inside candle, so I have to wait for it to develop. What we see here, ladies and gentlemen, this particular inside candle, this one, small one, happens by the books, all right, because this pair is extremely volatile. That's why we have it. On something smaller, something with the lower volatility as compared to different low volatile pairs, this particular inside candle would be a doji. or a small hammer, for example, something like that, reversed hammer. What we're looking at is this to appear, the wide range candle and the small inside candle that closes lower than the previous low. So you see simple rules that define the strength of the strategy if you use it correctly. So the more complicated thing here, ladies and gentlemen, is not that you cannot use it on anything, but to identify this entry point, because this entry point is crucial. Now, as you can see, when the market opens with the next candle here, when you should actually sell, this point comes within seconds, and you've already lost 1/3 of your profit. Even if you enter here, when this candle closes, there is also another inside. Okay? This is also another inside. You can see how it forms, closes lower. And there is another long one. So you see, then it's a retracement. Much of a three black crows type of, how to say, three black crows candlestick pattern. That's what it looks like. 3 large candles, 2 retracing. 3 large, 2 retracing. There is, of course, the other one, which is to the upside, and it's called 3 white soldiers. So it's 3 up, 2 down, 3 up, 2 down. But this is more basic type of strategies, which we're not going to go into. But what you need to look at here is how flawlessly it actually, performs in this case. And our exit is here. This is our close. Flawless, unless you wait too long to get to your selling point. You see, this is a 5-10 range from here to here, something like that, 5-10 pips, where exactly the market is retracing. And yet again, if you wait for too long, you will get even 100 in range. So that brings me to let you know exactly where your stops are. So let me just align those figures one more time, okay, the way they were. And our stop loss, we should always set it up 5 up to 10 pips. My preference is about 10 pips above the shadow of the inside candle. So this is our stop loss here. This is what we need. The first thing, you enter the market, set up your stop loss. 10 pips higher than the inside candle. Second thing, set up your trailing stop, if you wish, with the same size, about 10 pips. But sometimes the market fluctuates with 10 to 20 to 30 pips to the upside during this 4-hour trend. So I would suggest about 50 to 60 pips of range trailing stop, because when the market starts retracing with a large force, in order to retrace 50, 60 pips, that means that it's going to get steady. It will end up in a sideways range and then either reverse or continue, which is a game of guess, and we don't play a game of guess. That's about it. Open, stop loss, close. The rules: not more than 2 trades, always close after the 4 hours, and 15-minute chart only. One more time, an optional one. You can use the 5-minute chart, but it will give you more false signals instead of the 15-minute chart. That's all. Well, I can see a lot of questions are coming in, especially for the sessions that I mentioned. So I will allow me to address those after the session is over in a couple of minutes. I will personally get in touch with you. I can see that you're leaving your contact details. So anything that you want to ask during over the email, we will review our email address, which is webinar@gdmfx.com, and we will of course answer all of your questions one more time. Thank you everyone for joining us today for this webinar. During the Easter holidays, of course, which are upcoming this week, Friday, Saturday, Sunday, and Monday, we will have no webinars as we usually have on Friday. So the next webinar, as you already know, comes up on next Wednesday, and we will have a look at short time frame strategy, focusing on 1-minute chart to 5-minute chart, and decision making on 5-minute chart. 1-minute chart analysis, 5-minute chart profit taking. This is a so-called scalper strategy for those that are interested in trading on multiple positions, multiple instruments. We'll have a look at that next Wednesday. Thank you very much for joining us. See you next time. Bye-bye.